Hello, traders. Welcome to our weekly outlook where we will go over what's going to happen for the week coming and also recap what had happened last week. So let's talk about what happened last week for January 23rd to January 29th, which is today. Right now it's about 11 p.m. Eastern Standard Time. So last week, Monday, of course, we start with the ECB Draghi spoke, which didn't provide too much insight. But basically, throughout last week, we continue to have many disputes from European nations for ECB's policy. Now, particularly from Germany, because Germany has been doing well economically speaking. So they just don't want to see this low interest rate continue. As mentioned, that low interest rate will always benefit one group of people, but it will not benefit the other part of the people. So if you keep the interest rate so low, it's of course going to hurt the savers. However, what we saw from ECB's response is that they are very firm about their policy. And basically, this just signals that the euro is going to continue to be weak, continue to be cheap because of ECB's easing policy. And now just give us more confirmation for the fundamental side of euro. Tuesday, we had the service PMI, manufacturer PMIs from many European countries. Again, they all came out quite positive to signal this quite divergence between some of the strong European nations toward ECB's policy. And Tuesday, we also have High Court ruling coming out from UK, which told us that the Brexit had to go through the parliament. This was expected, not a surprise. However, this whole thing has pushed British pound even further upside. Now, ever since the week before last, January 6-17, after the Prime Minister May's speech, British pound has enjoyed a very strong sentiment. Now, this High Court ruling once again has injected a more strong sentiment into British pound. So what happened right now is that this hard Brexit ever since 2017 has become quite soft. What does that mean is that if you think about it, it's no longer a real uncertainty like what we had in 2016. Because right now, basically, everybody knew Britain is going to leave euro for sure. And now everybody knows they are going to trigger this Article 50. Prime Minister May had to reveal her plan. Everything become more and more clear. And now the parliament has to involve. So again, how they do it will be even more mild. So we went from a sort of a radical divorce to a mild separation. And of course, that's going to calm the market down and, of course, continue to support British pound. And on top of that, Britain also has a GDP data last week, which came out actually quite surprised. It was not negative. It's not positive or negative. It was in line with previous GDP, but it was much better than the economist prediction. Now, you have to understand why economics predict GDP to be lower for Britain. Very importantly, it's because the currency has been devaluated. Now, when a nation's currency like British pound has been dropped such in a fast, accelerated speed, that's gonna cause goods become more expensive because your money becomes cheaper. And that's going to reflect in the price, which has already reflected in their last inflation data. Now, since the inflation is higher, it means products become more expensive. In theory, when products become more expensive, that should discourage buyer to buy more things. So that's why the economists were thinking the GDP should drop. Now, we did not see that happening. And that just provides us that British actually are more resilient in facing of this Brexit. And if you think more in the depth of that, you realize the real referendum back in 2016 was actually, of course, a win for the Leave Party. And that win was about 50%. So what does that tell us? Is that really more than half of the nations, more than half of people are actually ready to leave euro, and a lot of people are ready to basically face the hardship in order to leave the euro family. So that's why they might act irrationally, or they might act differently than theory. I still think the high inflation is going to reflect in the consumption behavior, which in turn will reduce GDP. But from the last GDP number we saw from UK, it just shows they are much stronger than a lot of people's prediction. And if you realize that's basically what had been happened ever since they vote for Brexit, because right after that, the economists were predicting a recession right away. That did not happen. They were predicting all the data to decrease, to drop, and that did not happen. And now this newest GDP, they were to predict a decrease in the GDP number. That also did not happen. So really, you have to understand that sometimes the human behavior are not explained or outside the economic theory. That's why it's called a theory, right? It's not a Bible, or it's not a fact or truth. So, of course, that's really once again helped the sentiment into British pound. So British pound really has somehow become a very strong currency right now, both sentimentally. Fundamentally speaking, yes, the outlook is still kind of doomed. It's because things are still not kind of unclear. But you have to know that, they had the first meeting between Donald Trump and Prime Minister May last week, that this crisis might actually be a great opportunity for Britain, because they might actually be able to negotiate a better deal with US. We just don't know what's going to happen in the future. And for Britain, it's really like a concept of the worst had happened. So what more can it go wrong? Because 2016 was really the worst year for British pound. It was the worst year for Britain, and it was really a lot of panicking moment for UK. And it's just like human behavior. If the worst has happened, then what's going to happen next can only be better. It's not going to be best, but it's going to be better. And if it's going to be better, of course, that's good for the country. It's good for the currency. So that's my stance for the British pound. It's actually become quite a strong sentiment. We also have the CPI data from Australia, which came out soft, and as mentioned, this is actually a very significant thing to take into consideration. I'll talk more about the Australian economy, but basically it's just basically painted another negative sentiment over Australia. On the contrary, Wednesday we have the CPI data from New Zealand, which actually came out very surprisingly positive. So that, completely opposite than Australia, although they are neighbor countries, that has pushed New Zealand dollar to become the strongest currency for last week. And then Wednesday, you also have a crude oil inventory, which came out as a large build-up. But basically, for Canadian dollar right now, it's more a neutral position, because on the other hand, you have the oil market. Oil market is more in a positive direction with occasional volatility, because yes, the crude oil inventory is important, but that's largely for the shale producers. Right now, OPEC still control a much larger influence over the oil market. And right now, all the news and data from OPEC had been quite promising. They are fulfilling their promise and agreement, and they have made about 80% of their target. So although the shale producer from US is going to take this advantage to pump up more oil, but basically the OPEC curve is going to hedge this out. So for Canadian dollar right now, the future really now lies on the oil market, because we know the oil market is going to go to $60 per barrel minimum. Again, we just don't know how smooth that path will be. The real issue for Canadian dollar really is the NAFTA deal between America and Canada. That will play a much significant effect for Canada, because Canada has pretty much exported 70% of their goods and services to America. So that will be a much bigger issue, and we'll have to see what happened. Now, my personal view is that I don't think it's going to be too negative, because the biggest difference you have to understand, the biggest difference between America and Mexico is that Mexico produce a lot of goods for American, a lot of their agricultural products, a lot of labors. So those are important, but American can, simply buying those goods from other countries, in terms of fruits, in terms of stuff like agriculture. For Canada, it's a much different story, because Canada export a lot of energy and natural resources. That's not only the oil, also including water, and forestry. So for American to find a replacement for this kind of resources, it just basically it's impossible and it's illogic. And you can already see the reflection already that Donald Trump has proved the Keystone Pipeline and the North Dakota Pipeline. And those pipelines are going to direct transfer crude oil from Alberta to the south of U.S. So that just shows that basically U.S. can live without a Mexican product, but they cannot live without the Canadian resources. And it's just so important for U.S. to really build this connection with Canadian resources. So that's why the NAFTA deal, yes, it might change. Yes, it will definitely shift a little bit, but it's not going to be a drastic, completely opposite reaction where you see between Mexico and U.S. right now. Because Mexico and U.S., first of all, are completely different countries. One is a developing country, one is a developed country. Second of all, they don't even speak the same language. They don't have the same culture. And so the trade war is very much likely to happen. For Canada, it's a completely different story. For U.S., again, rely heavily on the resources and energy. They both basically share the same culture and history, and they both speak the same language. So for them to really fight each other and become enemy, it's just not going to happen. So I don't think the NAFTA deal will be drastically abandoned between U.S. and Canada. What U.S. wants to do is really just to renegotiate a better term. So I do think it's going to be a sort of a neutral outcome. It might be actually a positive outcome. We never know. So really for Canada, it's a more neutral stance for me. Because the oil market is going to continue supported. The NAFTA deal will create a short-term volatility, but it's not going to be a long-term effect. It's different than Mexico. On the other hand, Mexico might really suffer from Donald Trump's policy. So that's a completely different story, just to give you a more micro picture. So Thursday, we had a UK GDP, again, just mentioned. That was a very nice push up for the British pound again. Friday, we finished the week with advanced GDP from US, which was quite disappointed. So this disappointed data, along with the already negative sentiment from Donald Trump, painted a quite a mixed picture, but generally speaking, it's a more dovish sentiment, more bearish sentiment for the US dollar as we finished last week. So let's take a look at for today. Sunday, we actually, over the weekend, Saturday we have nothing. Sunday we actually have a New Zealand trade balance came out earlier in the Asian session. It was quite positive. So we actually, because of that, we do assume that New Zealand dollar might continue the strength all the way until next week. And we also have a retail sale came out from Japan, which was lower than previous and expected. This, of course, will continue to pressure Japanese yen. And as many of you know, on Monday, we are going to have the Bank of Japan policy statement. Now, for Japan, the retail sale lower than expected number, really it's a very not promising pictures, because they already pushed back their sales tax rise in 2019. So that means basically whenever they raise sales tax, the sales number decrease. So that's why Bank of Japan or the Japanese government, the hands are tight, because they do need a more tax revenue. But if you raise the tax, try to increase the revenue only to see the volume dropped, that's not going to be a good thing. So for Bank of Japan, really, although their inflation has picked up, there is no way they are going to basically tapering the bond buying or the interest rate. There's nothing they can do. So we do think that Monday they are going to keep the interest rate, if any, or they might even cut it or even increase the bond buying. All right. So for Japanese yen, it's still a very negative outlook. For this week, January 30 to February 5th, okay, we are actually finished January. As mentioned, time flies by, and we really already finished the first month of 2017. I hope all you guys had a wonderful month, and let's looking forward to February. February Monday is going to be a quiet day, without any tier 1 data in London and New York session. But we have some, we don't have a tradable data, but we do have quite a few data. We have German preliminary CPI, we have a US core PCE, personal spending, pending home sales. Now, these data are not tradable for me, but they are important for the micro picture. So do take a look at that. Asian session, of course, we will have the Bank of Japan interest rate decision, which often will be quite volatile for the market. Mainly you have to watch out, not the interest rate, because again, interest rate is expected to be unchanged, but look out their policy statement. What are they going to do? And about an hour or two after that, we will have the press conference from Bank of Japan. That's also going to be quite volatile. Tuesday, we also have the ECB Draghi speaks. We also have the CPI data and GDP data from Eurozone. We also have the GDP data from Canada and the US consumer confidence. I will put all these things later on below. It will be more clear to you. Tuesday, we also have the employment data from New Zealand. And Bank of Canada, Paulos will speak after the New York session, which it's kind of a bizarre time, but that's just a schedule. So he will speak at about 5:30 p.m. Eastern Standard Time. We also have Chinese manufacturer PMI coming out on Tuesday. Wednesday, we have manufacturer PMI from many European countries, and followed by UK manufacturer PMI. Actually, you know what? Let me pull out the Forex Taster, because it's much clearer to see in that way than the word. Okay, so Tuesday, again, which is employment rate, employment change from New Zealand. That was Tuesday. This is quite important if you are currently buying New Zealand dollar, which I am. Wednesday, manufacturer PMI and many manufacturing data from European nation. Then we have ADP non-farm employment change. This is more like a preliminary data for Friday's non-farm payroll. So you can take a look at that. Normally, this one and non-farm payroll will be quite in line, will be quite congruent. We also have ISM manufacturer PMI, crude oil inventory, and finally at 2 p.m. Afternoon, we have the FOMC statement. Thursday, we start with construction PMI from UK and the Bank of England rate decision. Then we have ECB Draghi speaks, following by BOE Carney speaks. And then we have unemployment claim. This is a usual report, following by Asian sessions manufacturer PMI once again from China. And finally, on Friday, we start with the service PMI all the way until New York session. We have the first Friday of the month, non-farm payroll for US. Then we finish the week with 10 ISM non-manufacturing PMI. So if you just take a look at what's going to happen next week, it's actually a quite busy week. Consider last week it was not that busy. So really the only quiet time will be basically Monday. Monday is quiet until Asian session. So basically after Monday Asian session, things will start picking up and will become very, very busy all the way until Friday. So expect a quite volatile market. Okay. So what's our view right now? Okay, so again, because of the nature of the important data, especially you have 3 central banks that are going to come out this week. So a lot of this thing will change the fundamental perspective, because the central bank, although they will keep the interest rate, but they might change their future policy. So because of that, what we predict or what's our outlook for now might completely change after this week. So just to keep that in mind. But here is our outlook for now for this week. For Euro, we are thinking it's still fundamentally bearish and sentimentally neutral. Now the bearish is because the ECB continue to ease and keep the low interest rate market. That's also going to keep Euro become a very cheap currency. So fundamentally, it's still a very weak currency, very bearish currency basically. Sentimentally neutral is because ECB basically is not in the headline for this week, right? They already released their rate decision 2 weeks ago. So they are outside this sort of battlefield. Because of that, so anything happen this week will reflect to ECB. ECB will basically become a safe haven currency. So Euro will become a safe haven currency, especially for this week. And that's why they are sentimentally neutral, because if we have a very negative view for example, for Bank of England, Bank of Japan, or even Federal Reserve, that will push money into Euro, because although Euro is fundamentally bearish, but people like to park their money there because at least for now, they are neutral, they are clear about their future plan. So that's why it's a sentimentally neutral currency. We will have to see how other risk events unfold before we decide what's going to happen to Euro. For British Pound this week, we think again they are fundamentally bearish and sentimentally bullish. So quite an opposite effect. Fundamentally bearish because right now with the Brexit, with the Article 50, is still up in the air. Basically, the future is still uncertain. And the devaluation of the currency of British Pound is going to reflect in inflation. It has already reflected in the inflation. That will, in theory, discourage consumption because the goods and products will become more expensive. That's a theory, that's a fundamental effect. That's why it's a bearish currency. Sentimentally, it's bullish. Again, it's because right now, all the previous uncertainty has been diminished greatly. So really, you don't have anything that's going to basically make investors scared. For Article 50, right now, you have to go through the Parliament, and Parliament is scheduled to debate for the bill in February. So as I mentioned, right now, once it goes to a Parliament, it's going to drag out a bit. So it's not going to be quite a volatile event anymore. So that's why the bullish sentiment comes in to basically makes people to buy back British Pound, because it has been sold quite heavily all through last year. On top of that, you saw the news that Prime Minister May actually traveled to US and met with Donald Trump. So as the first nation to actually meet with Donald Trump, that actually provided a lot of sentiment, because we know that UK is not really in a good term with European nations, right? A lot of speculation saying that the European nations are going to punish UK for leaving Euro because they have to set example. Now UK become the first leader to visit Donald Trump. They might actually again create some sort of new positive outlook. And as I mentioned, the most important thing about UK is that the worst had already happened in 2016. It's basically like you having a shitty day, and then maybe you have a completely unfortunate event throughout the morning till the night. What's gonna happen is that things are gonna be better, right? It's not because you have a good day; it's because you have a shitty day. So what's going to happen in the future? Statistically speaking, is going to be better, because how low can you go? That's basically the concept. So that's basically the sentiment for British Pound as well. That's why you see a lot of people are buying into it, because we already seen the worst. We already see they made this historical separation, and now because of Donald Trump, that actually helped UK tremendously. So sentimentally, it's a quite bullish currency. But how do you play it? Well, because it's a sentimentally bullish, you could always trade daily or intraday, or in a shorter time frame to buy British Pound. For me personally, I will trade service PMI if it's positive for this week. Also, look out for Bank of England. rate decision, which is expected to be unchanged. So we just want to see how Carney pan out the future for Britain. For US dollar, it's fundamentally bullish and sentimentally neutral. Fundamentally bullish is because the solid economic data continue to support US. You also see Dow Jones making history last week. So fundamentally, if you know, besides from all the political drama, look at the data itself, it's a very strong nation. Also, just to mind you, among all 8 major countries, US is really the only one that is going to hike the interest rate in 2017. That alone is a very strong indicator, because if you look at all the other nations, the best they can do is to not cut further. But no other nation can be so certain with this kind of probability to hike their interest rate. And that just shows you how strong the US economy has recovered and has grown. So fundamentally, it's no doubt it's a bullish currency. Sentimentally neutral, well, I don't need to mention it's because of Donald Trump. Now, what happened to Donald Trump is because the policy now starts to unfold, and there is, I don't know whether it's good or bad, but I know it's going to be uncertain. Now, as I mentioned, market does not like uncertainty. So the policy of course, going to create a lot of sentiment, and those sentiment will reflect in the market. So occasionally you will see a strong US dollar sentimentally. On the other hand, occasionally you will see a very bearish sentiment US dollar. So it's basically going to become like this for the next few weeks. Now, in this case, if you want to buy US dollar, definitely don't go anywhere lower than, daily, because the fundamental things eventually gonna revert back to the fundamental, but you don't want to get caught up in the sentiment trap. So that's something you have to be careful. And so be careful for buying US dollar, and but fundamentally it's a strong sentiment. It's a strong fundamental currency. The NFP this week, non-farm payroll, will be a main driver for US dollar. It will show us what's going to happen. And the Federal Reserve statement will also give us a quite nice insight. We do think the Fed is going to basically keep the interest rate unchanged. Not only that, we do think their tone will be quite cautious, because following by President Trump's continuously of the policies, and also judging by Yellen's conservative behavior. So we do think they will be quite cautious. They're not going to hype up, say, oh yeah, we're going to raise the rate very soon. They'll probably be cautious and wait for the policy to take effect more. So that's what we think. And that cautious tone might push down US dollar. So just that you have to be careful. By the way, guys, I'm going to publish this written article on my website, so you can get more detail, because I'm just gonna go through it very fast. But if you like to see more detail, there's a lot more good inside these things. Okay, so for Canadian dollar, we think it's fundamentally neutral and sentimentally neutral. Now, it's both neutral is because, again, oil market is going to support Canadian dollar fundamentally, but the NAFTA deal might basically change the outlook fundamentally. Sentimentally, again, the oil market is going to provide a lot of good sentiment, but a shale producer is going to pump out more oil, more inventory to provide a negative sentiment. And on top of that, the Canadian economy itself is really up in the air, right? It's really uncertain. You have a better labor market, but you have a worst retail sales. You have the worst. I think besides labors, anything else is not too promising. So this week we will have the GDP data. That's going to be a major driver for Canadian dollar. Again, besides from that, if you want to trade Canadian dollar, you gotta watch out the relationship between oil market and also how the NAFTA deal pans out. But the GDP data will be a good internal effect for Canadian dollar. For Australian dollar, we think it's fundamentally bearish and sentimentally bullish. Now, last week's CPI data, of course, it's revealed a fundamental weakness. If you really just looking at data itself, Australian is in sort of a technical recession right now. What happened is that the previous two GDP has contracted consecutively. And the last GDP actually, shrank by 0.5%. So that's really a worry sign because it's the first time in 5 years for Australia to has a shrinking GDP. On top of that, their employment data was a mix. Remember that was 2 weeks ago. Employment data were a mix. That is not really promising. And now the CPI data were also a mix. So what's that gonna make the central bank do? Well, they are going to, of course, do something about it before it's too late. They're not gonna wait for labor market to go down or wait for the CPI data to go even worse, right? Because now the GDP has already reflected that the economy is in sort of early sign of trouble. So that makes RBA will most likely have higher possibility to cut the interest rate to basically stimulate the market. And because of that, this is going to diminish Australian dollar. So Australian dollar really right now fundamental bearish. Now, sentimentally, it's bullish. It has been bullish basically. What you see in 2017, Australian dollar is the strongest currency so far. But this bullish sentiment largely came from the commodity price has picked up, and mainly because the Chinese economy continued to grow. But these two factors they are very unstable. The commodity price might pick up mainly because of speculation. And what we seen last year is when Chinese government paused the speculation, they basically halted the market, you see a huge drop in Australian dollar very, very fast. So this thing is very unstable. And the Chinese economy itself is also unstable. It is growing, but it's growing in a much slower speed. And economically speaking, it's going to keep decreasing. So if the Chinese demand keep decreasing, from both fundamentally and speculatively, that's going to affect Australian dollar. Then what's going to hold Australian dollar will have to come from its internal economic strength, which we saw that it does not have any, because right now the GDP has shrinked and the CPI and labor market are all quite soft. So that's why it's a good picture, but basically be careful. A lot of people are buying Australian dollar thinking it's going to be a strong currency for 2017. I don't really think that's the case right now, because what's pushing it up basically for this January is really completely from the sentiment. It's nothing to do with the fundamentals. For New Zealand dollar, on the other hand, it's really the strongest currency we think right now. Fundamentally bullish and sentimentally bullish. Now, first of all, New Zealand ended 2016 with a growing GDP, the lower unemployment, and the only downside was the low inflation back last year. So because of that, last week's CPI was such a huge effect, because that's the three major elements of every country. If you want to look at the big picture, GDP, employment data, and inflation. New Zealand already scored high for GDP and employment data at the end of 2016. So the only thing that dragged them down was the CPI data, was the inflation data. So that's why last week's the inflation actually showed a great achievement, a great result. That has now put New Zealand at a very strong spot, because now the GDP is good, employment data is good, and the inflation data is also very good. So because of that, it became a very fundamentally strong currency. Now, it's sentimentally strong is because New Zealand is completely outside the current geopolitical events. You know that New Zealand is geographically located in a very isolated area. Because of that, it's really outside this Donald Trump effect. It doesn't have anything to do with Euro, UK, Canada, Mexico, and even China. They're not in any trade war with anybody. They're basically just very peaceful in the spot of the world. So that's why sentimentally it's quite bullish as well. Now, whenever you have this kind of effect, fundamentally and sentimentally bullish, that means this currency is currently very, very strong. Now, for Japanese yen, it's fundamentally bearish and sentimentally neutral. Fundamentally bearish, what I had mentioned before, they are still in this low inflation market, and we don't see and we don't see BOJ or government of Japan to basically stop easing anytime soon. So Japanese yen still remain a very bearish currency. Sentimentally neutral for a very simple reason, because of safe haven currency status. So if this week, as I mentioned, lots of risk events, if anything goes wrong, money will always flee into Japanese yen. So that's just the nature of Japanese yen. It will always be quite sentimentally neutral. And especially this week when you have such a lot of risk events, also give Japanese yen a more chance to benefit from the inflow of panic money. Swiss franc is in the exactly same spot as Japanese yen. Both are very low inflationary market. They both rely heavily on trading. They both, central banks' policy is to keep easing and stimulate the market unless they can pick up the inflation. So they are exactly same spot, fundamentally bearish, and it is also sentimentally neutral for Swiss franc. It's because the safe haven status. So that's pretty much the outlook right now for these 8 major currency. And things that might change again is British pound, because the Bank of England policy meeting this week, US dollar because the Federal Reserve policy meeting, and Japanese yen because the policy meeting. Now, we don't expect things to change too much, but it will give a more clear direction. So if you just look at that, for me right now, the really short thing is New Zealand dollar, which you have both fundamental and sentimental data goes to the same direction. However, New Zealand dollar will have a new employment data this week, which is the risk, because we don't know